Are you 60 years old and still struggling to make ends meet, watching your bank account with more fear than hope? If that's you, I need you to understand something right now. You're not failing at retirement. Retirement planning has been failing you. The advice you've been following, the strategies everyone told you were guaranteed to work, they were designed for an economy that died decades ago, and continuing to follow them is like trying to navigate with a map from a country that no longer exists. Here's what nobody wants to tell you. When you hit 60 and your financial situation isn't where you thought it would be, panic sets in. You start making desperate decisions, throwing money at problems in ways that feel responsible, but actually make everything worse. You drain your savings accounts trying to become debt-free, because that's what you've always been told to do. You cut back on everything that brings you joy, living like a prisoner in your own retirement, convinced that suffering now will somehow fix decades of following the wrong playbook. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Has this ever happened to you? You're sitting there at your kitchen table, calculator in hand, trying to figure out how you're going to make it through the next 20 or 30 years on what feels like half the money you need. Your friends seem to be doing fine, posting vacation photos and talking about their comfortable retirement, while you're quietly terrified about every unexpected expense. You thought you did everything right, you worked hard, you saved when you could, you listened to the experts, yet somehow you're still broke at 60. The uncomfortable truth that financial advisors don't emphasize enough is this: after 60, time stops being your friend. When you were 30 or 40, you could recover from mistakes. You had decades for compound interest to work its magic, years to rebuild after setbacks, time to course correct when things went wrong. But now, every financial decision you make carries weight that younger people can't even comprehend. Every dollar you misallocate is a dollar you might desperately need 5 years from now, and you can't get those years back. What you're about to discover might completely transform how you think about money, debt, and survival after 60. Because the strategy that might save your retirement isn't about living smaller or sacrificing more. It's actually about doing the exact opposite of what conventional wisdom has been drilling into your head. Stay with me until the end, because the perspective shift you're about to experience could be the difference between spending your remaining years in quiet desperation and actually having the breathing room you deserve. The financial rules change entirely when you cross that 60-year threshold, and most people don't realize it until it's too late. What looked like security, like paying off your house completely, can actually become the most dangerous trap. What felt like responsibility, eliminating all debt no matter the cost, might be the decision that leaves you more vulnerable than you've ever been. The question isn't whether you have debt or not. The real question is whether you have the liquidity, the accessible cash, the financial flexibility to handle what life throws at you when emergencies stop being hypothetical and become your daily reality. And that's exactly where we need to start. Let me tell you something that wealthy people understand instinctively, but nobody ever explains to regular folks struggling to make it work. Every single dollar you have sitting in your account right now has a job it could be doing. And when you take that dollar and throw it at paying off a low-interest mortgage early, you're not just eliminating debt, you're firing that dollar from a job that could have been paying you instead. This is the hidden truth about opportunity cost that changes everything once you see it clearly. Think about this for a moment. If you've got a mortgage charging you 3 or 4% interest and you take $50,000 from your savings to pay it down, what have you really accomplished? Sure, you reduced your debt, but you also just chose to not let that 50,000 earn anything for you. That money could have been sitting in treasury bonds right now earning 5%. It could have been in dividend-paying stocks generating income every quarter. It could have been your emergency fund, your opportunity fund, your sleep at night knowing you have options fund. Instead, it's gone, locked inside the walls of your house where you can't touch it without selling the property or begging a bank for a home equity loan. The transformation in thinking happens when you stop seeing debt as this universal evil and start seeing it as one piece of a larger financial puzzle. Has this ever crossed your mind? You're receiving Social Security every month. Maybe you've got a pension or an annuity. Those checks show up like clockwork regardless of what you owe. That's guaranteed income, money you can count on whether you have a mortgage or not. So why would you drain every accessible dollar you have to eliminate a debt that your guaranteed monthly income already covers comfortably? If this perspective resonated with you, subscribe to the channel. I create content that challenges conventional retirement advice with strategies that actually make sense in today's economy. This is where the mindset shift becomes crucial. Your Social Security isn't just retirement income, it's built-in debt coverage. Those monthly deposits mean you can service a reasonable mortgage payment without touching your savings, without liquidating investments at bad times, without scrambling when the water heater explodes or your spouse needs an unexpected medical procedure. The impact of understanding this distinction is profound because it means you can maintain financial flexibility while your guaranteed income handles your obligations. But there's something even more fascinating happening behind the scenes that most people at 60 completely miss. We're living through an economic environment where inflation is actually working in your favor if you know how to position yourself. When you're carrying a mortgage at 3 or 4%, but inflation is running at 4, 5, or 6%, something magical happens to your debt. It shrinks. Not on paper, the balance stays the same. But in real purchasing power, every year that passes, your debt becomes cheaper because the dollars you're using to pay it back are worth less than the dollars you borrowed. Let me make this concrete, because this revelation changes how you should think about every financial decision. 5 years ago, if you borrowed $200,000, those were more valuable dollars than the ones sitting in your account today. Inflation has been quietly eroding the real cost of your debt while you sleep. Meanwhile, if you had taken a lump sum and aggressively paid off that loan, you would have used today's more valuable dollars to eliminate debt that was already becoming cheaper on its own. You would have essentially volunteered to lose purchasing power, fighting against an economic current that was already flowing in your direction. The journey toward financial security after 60 isn't about following some rigid rulebook from decades ago. It's about understanding how money actually works in the real economy you're living in right now, today, not the economy your parents navigated. Now, I want to go even deeper into this topic because there's another dimension to this decision that affects your immediate situation in ways you might not have considered. The choices you make with your cash right now, in the next few weeks or months, could determine whether you spend your remaining years with breathing room or constantly anxious about where the next dollar comes from. And that's precisely where most people at 60 make their biggest mistakes, not because they're careless, but because they're following advice that sounds responsible but creates exactly the wrong outcome for their specific circumstances. Write in the comments, opportunity cost matters, if this perspective is starting to shift how you're thinking about your own situation. Here's what nobody tells you about the moment you write that final check to pay off your mortgage completely. That decision is permanent. It's irreversible in ways that should genuinely concern you if you're 60 and your financial margins are tight. You can't wake up 3 months later, realize you made a mistake, and call the mortgage company asking for $20,000 or $30,000 back because your spouse needs surgery or your roof is collapsing. That money is gone, converted into home equity, which sounds impressive when people ask about your net worth but does absolutely nothing for you when real-life emergencies hit. The transformation you need to understand is this. Liquidity, the ability to access your money quickly without jumping through hoops, matters infinitely more than the psychological satisfaction of owning something outright. Because if you need cash after you've paid everything off, your only options are selling your home, which takes months and uproots your entire life, or applying for a home equity line of credit. And that process, you'll go through underwriting again, providing income documentation as a retiree, possibly getting worse interest rates than you had before, definitely paying fees and closing costs, all while you're stressed about whatever emergency forced you to need the money in the first place. This is the hidden trap that catches people who thought they were doing the responsible thing. They achieved debt-free status, felt proud for about 6 weeks, and then reality reminded them that life doesn't stop throwing curveballs just because you paid off your house. The impact of this irreversibility becomes painfully clear the first time you need significant cash and realize you've locked yourself out of your own money. Behind the scenes of financial security isn't a paid-off house. It's accessible resources that you control and can deploy immediately when circumstances demand it. But there's another dimension to this that affects your taxes in ways most people at 60 never consider until it's too late. When you have a mortgage, that interest you're paying, it's tax deductible. Every dollar of interest reduces your taxable income. And for retirees who find themselves in higher tax brackets because of required minimum distributions from retirement accounts or pension income, this deduction can save you thousands of dollars every year. The revelation here is that when you eliminate your mortgage entirely, you simultaneously eliminate this valuable tax shield, which means you could end up paying significantly more to the IRS just for the privilege of being debt-free. Think about the journey of your money for a moment. Sometimes, when you factor in both the tax advantages and the inflation effect we talked about earlier, the true cost of carrying that mortgage debt is actually negative. You're essentially being paid to borrow money when you account for all the factors working in your favor. These are the calculations that sophisticated financial planning considers, but conventional wisdom completely ignores because it's stuck repeating the same tired advice from 40 years ago. Now here's where we need to make a crucial distinction that changes everything about how you evaluate your debt situation. Not all debt deserves the same response. If you're carrying credit card balances at 18 or 20% interest, that's financial cancer eating away at your future with mathematical certainty, and you need to eliminate it immediately without question. That's dumb debt, expensive debt, the kind that genuinely is your enemy. But a low-interest, fixed-rate, tax-deductible mortgage at 3 or 4%? That's not your enemy. That's actually a sophisticated financial instrument working in your favor when you understand how to position it correctly within your overall strategy. The mindset shift required here is learning to distinguish between destructive debt that's stealing from you and strategic debt that can actually enhance your financial flexibility and security. This distinction matters enormously because it determines whether you're making decisions based on fear and outdated rules or based on mathematical reality and strategic thinking. What becomes clear through this journey of understanding is that the wealthiest retirees, the ones who maintain genuine security through their later years, they're not rushing to eliminate every obligation. They're maintaining structure, preserving options, keeping their capital working for them instead of locking it away where it can't be accessed. Drop a comment saying liquidity first if you're starting to see why having accessible cash might matter more than being completely debt-free. Let me paint a picture that illustrates exactly why throwing all your cash at your mortgage might be the Most expensive mistake you make at 60. Imagine you're sitting on $100,000 in savings and you've got a mortgage charging you 4% interest. The conventional voice in your head is screaming to pay off that loan immediately, eliminate the debt, feel the relief. But what if you kept that mortgage and instead put that 100,000 into a diversified portfolio of stable investments earning 7 or 8% annually? The math isn't complicated here. You're paying 4% on one side while earning 7 or 8 on the other. That spread, that difference between what you're paying and what you're earning, represents real wealth accumulation happening every single year that you completely forfeit the moment you eliminate the debt. The revelation that changes everything is understanding that investment returns, even conservative ones, consistently outpace low mortgage rates over time. This isn't about taking wild risks with money you can't afford to lose. This is about recognizing that a well-structured portfolio, even a conservative one focused on stability and income, can generate returns that make keeping your mortgage the smarter mathematical decision. Behind the scenes of financial success at 60 isn't eliminating every obligation. It's strategically positioning your resources where they work hardest for you. But there's something even more powerful about maintaining this flexibility that goes beyond just the investment spread. The transformation in your security comes from preserving options. You can always decide to pay off your mortgage later if your circumstances change dramatically, if you inherit money, if your health situation shifts, if you simply change your mind after evaluating new information. That door remains open as long as you have the cash, but once you've taken that 100,000 and converted it into home equity, once you've made that payment irreversible, you cannot get it back without significant cost, time, and hassle. You've closed a door that's incredibly difficult to reopen. This is what I mean when I say flexibility is the hidden currency of retirement, worth more than almost any other financial metric you can measure. Having options means you can respond to whatever life throws at you. Medical situations that insurance doesn't fully cover. Family members who desperately need help at crucial moments. Investment opportunities that appear unexpectedly, or simply the desire to take that trip you've been postponing for decades while you still have the health to enjoy it. Accessible capital gives you the power to say yes to what matters without having to liquidate investments at terrible times or beg for credit when you're already stressed about an emergency. The journey toward genuine security isn't about rigidity, it's about adaptability. And there's another dimension to this conversation that people find almost uncomfortable to discuss, but it's critically important if you're thinking clearly about your entire financial picture. We've been culturally conditioned to believe that dying with any debt is somehow shameful, that you're failing your children if you don't leave everything paid off with a perfect bow. But the reality behind the scenes of estate settlement is completely different from what most people imagine. If you pass away with some remaining mortgage debt, your estate simply handles it as part of the settlement process. The house gets sold or refinanced, the debt gets paid from the proceeds, your heirs receive what remains. They're not personally liable for your mortgage. That's not how estate law works. The real question you should be asking yourself isn't whether you'll leave debt behind. The question is whether you want to spend your 70s and 80s living a constrained, anxious lifestyle, denying yourself experiences and peace of mind, all so you can leave an inheritance that's slightly larger. The impact of this perspective shift is profound because it forces you to confront what your money is actually for during these final decades. Your children, if you raise them with any financial intelligence at all, would rather inherit a smaller estate and have memories of parents who actually lived, who were generous when it mattered, who took the trips and created the experiences, than inherit everything while remembering parents who sacrificed unnecessarily and lived in constant financial fear despite having resources. This isn't about being irresponsible with money that should go to your heirs. This is about recognizing that being the richest person in the cemetery has never been anyone's genuine goal once they think about it honestly. Write "Living Now Matters" in the comments if this is making you reconsider what your retirement money should actually be used for. What was the point of all those years of hard work anyway? Why did you sacrifice weekends, delay gratification, save when you could, and push through jobs you didn't always love? It wasn't so you could spend your 60s and 70s obsessing over every expense and denying yourself the experiences you've been dreaming about for decades. You've earned the right to actually live, not just exist in some holding pattern waiting for permission that's never going to come from anyone else. The transformation that needs to happen in your thinking is giving yourself that permission right now, today, while you still can. Travel while your knees still work and you can navigate airports without assistance. Help your grandchildren with their education or their first home while you're around to see the impact it makes in their lives. Take that cooking class or that photography trip you've been talking about for 20 years. The hidden truth nobody wants to say out loud is that experiences have expiration dates, and your health and mobility are declining assets whether you acknowledge it or not. There are 70-year-olds hiking mountains, and there are 70-year-olds who can barely walk to their mailbox. Time isn't the only factor, but it's a factor you absolutely cannot negotiate with. Now, if you're sitting there thinking this all sounds reasonable, but you're genuinely broke at 60 with equity trapped in your house and no way to access it, there's a financial tool that could completely change your situation. And it gets an unfairly bad reputation because people don't understand how it actually works. If you're over 62 and own your home, a reverse mortgage can convert that illiquid equity into usable cash flow without requiring you to make a single monthly payment. Instead of draining whatever savings you have trying to stay afloat, you tap into the wealth you've already built in your home, stay right where you are living in the house you love, and defer any repayment until you decide to sell or until your estate settles things after you pass. The revelation about reverse mortgages is that they've evolved significantly from the horror stories you might have heard decades ago. The modern reverse mortgage landscape is heavily regulated, with consumer protections built in, and for someone who's house-rich but cash-poor at 60, it can be an incredibly strategic move. This isn't about losing your home or getting scammed. This is about accessing your own wealth while you're still alive to use it. Behind the scenes, financially sophisticated retirees use these instruments strategically because they understand that having cash flow matters more than having equity you can't spend. But here's the deeper truth that should reshape your entire approach to financial priorities at 60. Your mortgage, whether you have one or you're thinking about a reverse mortgage, isn't your biggest threat. Not even close. The real financial predator lurking in your future is healthcare costs. Medicare covers a lot, but it doesn't cover everything, and the gaps can be absolutely devastating. A serious illness, an extended hospital stay, the need for long-term care or in-home assistance. These expenses can obliterate a lifetime of savings in months, not years. The impact of this reality is staggering when you look at the actual numbers. Long-term care facilities easily cost $8,000 to $10,000 per month, and most people will need some form of extended care before they die. This is the hidden danger that nobody discusses at retirement parties, but it's the reality that determines whether your final years are comfortable or catastrophic. The journey through your 60s, 70s, and 80s requires you to prioritize real threats over imaginary ones. Manageable debt at reasonable rates is not the monster under your bed. Inadequate liquid reserves for medical expenses, that's the genuine threat that destroys retirement security. What becomes crystal clear when you understand this is that draining your liquid savings to achieve some symbolic, debt-free status, only to find yourself without resources when healthcare needs arise 18 months later, is precisely backwards. You can't pay a nursing home with home equity. You can't cover prescription costs with the satisfaction of owning your house outright. Preserving accessible capital for the healthcare contingencies that are almost certainly coming is exponentially more important than eliminating low-interest debt that your monthly income can already service comfortably. Comment: healthcare first. If you're realizing where your financial focus actually needs to be at this stage of life, here's the scenario that plays out more often than anyone wants to admit. You're 65, you've just drained $50,000 or $70,000 from your savings to pay off your mortgage early because it felt like the responsible thing to do. You sleep well for about 18 months, feeling proud of that accomplishment. Then your health situation changes. Maybe you need round-the-clock care after a stroke. Maybe your spouse develops dementia and requires memory care. Maybe it's something neither of you saw coming that completely reshapes your daily reality. Suddenly, you need $8,000 a month for care. And where does that money come from now? You can't write a check from your home equity. The nursing home doesn't accept payment in the form of "I own my house" outright. The transformation in understanding happens when you realize that the decision you thought was securing your future actually created the vulnerability you're now facing. This is the hidden trap of prioritizing symbolic achievements over practical readiness for what's actually likely to happen. Behind the scenes of retirement financial disasters are people who optimized for the wrong things, who focused on eliminating obligations while accidentally eliminating their ability to handle real emergencies. What's fundamentally different about being 60 versus being 30 is how risk itself works in your life. When you were 30 and you lost money in a bad investment or made a financial mistake, the solution was straightforward. You worked longer, picked up extra hours, delayed retirement by a year or two, rebuilt your savings over time. You had the ultimate insurance policy, which was more time and more earning capacity. But after 60, when your earning years are largely behind you, losing money doesn't mean working longer to recover. It means permanent lifestyle reduction. It means cutting back on things you've been looking forward to for decades. It means telling your grandchildren you can't help after all. The revelation here is that your risk tolerance hasn't just decreased as you've aged, it's actually inverted completely from what it was during your accumulation years. What seemed low risk at 30, like aggressively investing or taking calculated chances, becomes high risk at 60, and counterintuitively, what conventional wisdom calls risky, like maintaining manageable debt while preserving cash reserves, is actually the lower risk position when you understand how vulnerability really works at this stage of life. The journey toward genuine security requires you to redefine what risk actually means. Being illiquid, having all your wealth locked up where you can't easily access it, is far more dangerous than carrying debt that your income comfortably services. Illiquidity removes your ability to respond, to pivot, to handle the unexpected without being forced into desperate measures. You become financially brittle, and brittleness in retirement is how people with significant net worth on paper still end up in genuinely difficult situations when life happens. Think about the impact of maintaining accessible resources versus converting everything into home equity. With liquid reserves, when the market crashes 30%, you don't have to sell investments at the bottom to cover expenses. When medical needs arise, you handle them without panic. When your daughter faces foreclosure or your son needs help with a business emergency, you can respond without destroying your own security. This is what flexibility actually means in practical terms. It's not some abstract financial concept. It's the difference between weathering storms and getting capsized by them. The mindset shift required is recognizing that after 60, the goal isn't to eliminate all obligations at any cost. The goal is to maintain control over your choices and your circumstances. Behind the scenes of seemingly successful retirements are people who understand that accessibility trumps ownership, that flexibility beats rigidity, and that preserving your ability to respond to life as it actually unfolds matters infinitely more than achieving some arbitrary milestone that sounds good but leaves you vulnerable. What becomes increasingly clear is that the decisions you make about debt and liquidity at 60 aren't really about money at all. They're about preserving the quality and dignity of the life you have remaining. Put flexibility over rigidity in the comments if you're seeing how maintaining options might actually be the safer path forward. The deeper you go into this conversation, the more you realize that what we're really talking about here isn't debt management or financial strategy in some technical sense. What we're actually discussing is how you preserve the quality and dignity of the life you have remaining. This is about longevity and what that really means when you might have 20 or 30 years ahead of you. The transformation in perspective happens when you stop treating your 60s as the beginning of the end and start treating them as potentially a third of your remaining life that deserves to be lived with intention and without unnecessary fear. If you're carrying stable debt at reasonable rates, debt that you can manage comfortably with your monthly income, then the revelation you need to embrace is this: you have permission to actually use your money while you can still appreciate it. Nobody else is going to give you that permission. Your financial advisor might not say it because they're trained in caution. Your adult children might not say it because they're thinking about inheritance. But I'm saying it now. Travel while your knees still work and you can handle the physical demands of airports and walking tours. Help your grandchildren with meaningful things while you're around to see the impact it makes in their lives, not just as a line item in your will they'll receive after you're gone. The impact of giving yourself this permission is profound because it shifts your entire relationship with money from hoarding and protecting to strategically deploying for maximum life satisfaction. The journey you've been on for 40 years was about accumulation, about building up, about preparing for the future. But at 60, especially if you're still broke or struggling, that journey needs to pivot toward intelligent use of whatever resources you do have, not continued deprivation based on outdated rules that don't serve your actual situation. Now, there's something else happening in our current economic environment that creates an opportunity most people at 60 don't recognize. Having fixed-rate debt while simultaneously holding liquid assets creates a natural hedge that protects you regardless of which direction the economy decides to move. Think about how this works in practice. If inflation continues to spike or accelerates even further, your fixed-rate debt becomes increasingly cheaper in real terms, while your liquid assets can be repositioned into inflation-protected investments or simply used when dollars are worth less. You're protected on both sides, but what if the economy shifts the other way? What if we somehow slip into deflation, which is less likely but still possible given economic uncertainty? Having cash on hand means you can weather that storm while people who are illiquid struggle. Your dollars become worth more, you can take advantage of opportunities when prices drop, and you maintain stability while others panic. This is what resilience engineering looks like in retirement finances. You're setting up your structure so you have options no matter what happens, rather than betting everything on one specific economic outcome. The mindset shift here involves understanding that in our current environment of economic uncertainty, where nobody really knows whether we're heading toward more inflation, potential recession, or some combination nobody predicted, flexibility itself has enormous value. Behind the scenes of financial security at 60 isn't having the perfect strategy for one specific scenario. It's having a structure that can adapt to multiple scenarios without requiring you to make dramatic changes under pressure. Debt, when it's properly managed and understood within this framework, stops being this burden you're carrying and becomes a tool for navigating uncertainty. The hidden truth is that wealthy people understand this instinctively. They maintain strategic debt even when they could pay it off, because they recognize that having deployable capital matters more than achieving some symbolic debt-free status. They're not smarter than you, they're just operating with a different framework, one that prioritizes adaptability and option preservation over rigid adherence to conventional wisdom. What's becoming clear through this entire conversation is that being broke at 60 doesn't mean you're out of options. It means you need to think differently about the options you do have, and that thinking differently might require you to do exactly the opposite of what everyone has been telling you to do your entire life. Write "Adaptability wins" in the comments if this perspective on economic hedging is making sense to you. There's a specific nightmare scenario in retirement, and planning that financial advisors whisper about, but most retirees never adequately prepare for, and it's called sequence of returns risk. Here's exactly how it destroys people who thought they were being responsible. You retire at 65, you take a big chunk of your savings and write a massive check to eliminate your mortgage, because that's what you've been told to do. You feel incredible about it for about 6 months. Then the market crashes 30 or 40%, which happens periodically and will happen again. Suddenly, you need money for living expenses because Social Security doesn't cover everything, but your portfolio is down significantly and you have no liquid reserves left because you spent them all achieving debt-free status. Now you're forced to sell investments at the absolute worst possible time, locking in those losses permanently, reducing your portfolio's ability to recover when the market eventually bounces back. The transformation in understanding happens when you realize this sequence, retiring, then experiencing poor returns early and being forced to sell, is one of the most devastating scenarios that can happen to your long-term financial security. And it's completely avoidable if you structure things differently. The revelation here is that maintaining manageable debt while preserving your investment portfolio actually protects you from this exact nightmare. You can ride out market downturns without being forced to sell at the bottom, because your debt payments are predictable and manageable, and you have cash reserves to supplement your income during rough patches. This is what cash flow management actually means in practical terms. It's not some technical jargon that only financial professionals need to understand. It's the difference between a retirement that survives market volatility and one that gets permanently derailed by bad timing. Behind the scenes of successful retirements are people who understand that protecting against forced selling during downturns matters more than the psychological satisfaction of being debt-free. They've structured their finances so they have breathing room when markets get chaotic, which they inevitably do every few years. The impact of this protection is enormous because it means you can wait out the storm instead of abandoning ship at the worst possible moment. Now, before anyone misunderstands what I'm saying here, let me be absolutely crystal clear about one critical distinction. If you're carrying high-interest consumer debt, credit card balances at 18 or 20% interest, that needs to be eliminated immediately without question or hesitation. That's not strategic debt. That's financial cancer eating away at your future with mathematical certainty. Every dollar you're paying in interest at those rates is money that could have been working for you instead of enriching credit card companies. That type of debt deserves aggressive, immediate elimination using whatever resources you need to deploy. But here's where the mindset shift becomes crucial. You cannot treat a credit card balance at 20% the same way you treat a fixed-rate mortgage at 3 or 4% with tax-deductible interest. These are completely different financial instruments with completely different impacts on your overall security. The journey toward financial wisdom involves learning to distinguish between destructive debt that's genuinely stealing from your future and strategic debt that can actually enhance your flexibility and resilience when properly managed within your overall plan. What becomes clear when you make this distinction is that the conventional advice to eliminate all debt treats everything as equally dangerous, which is mathematically and strategically wrong. It's like saying all medications are bad because some medications have serious side effects. The hidden truth is that context matters enormously, and blanket rules applied without considering your specific situation, your interest rates, your liquidity needs, your income sources, will lead you to make exactly the wrong decision with complete confidence that you're doing the right thing. Comment: context matters. If you're seeing why not all debt deserves the same response at this stage of your life, if you're worrying about what your adult children will think when they discover you maintain debt through your retirement years, let me share something that might completely shift your perspective on this. Truly financially intelligent heirs, the kind who understand how money actually works rather than just repeating what they've heard, they'd much rather inherit an estate with some remaining mortgage debt and actual memories of parents who were generous, who traveled, who were present for important moments, who lived with dignity and joy, than inherit a completely paid-off house while carrying memories of parents who denied themselves everything, who couldn't help when help was needed, who spent their final decades in self-imposed financial prison. The transformation in how you think about this comes from recognizing that your legacy isn't just the dollar amount you leave behind. It's also the example you set, the experiences you shared, the help you provided when it mattered most, the memories you created together. Behind the scenes of families who feel genuinely grateful for their inheritance are stories of parents who used their resources wisely during their lifetimes, not parents who hoarded every penny out of fear while everyone watched them suffer unnecessarily. But let's go even deeper into the opportunity cost concept, because this is where most people's thinking completely breaks down. When you take $100,000 and throw it at a 3% mortgage, you're not making one decision. You're actually making multiple decisions simultaneously without realizing it. You're choosing not to invest that money in treasury bonds earning 5% right now. You're choosing not to put it in a diversified stock portfolio that historically returns 7 to 8% over time. You're choosing not to use it for experiences that would enrich your life in ways no percentage return could ever measure. The trip to see your grandchildren across the country, the medical procedure that would improve your quality of life, the ability to help your daughter avoid foreclosure, every single one of those choices carries weight. And the journey toward financial wisdom involves consciously recognizing that deploying money in one direction always means not deploying it somewhere else. The impact of this realization should fundamentally change how you evaluate any major financial decision at 60. It's not just about whether paying off debt is good or bad. It's about what you're giving up to achieve that goal, and whether what you're gaining is actually worth more than what you're sacrificing. Now, here's the reality that should terrify you more than any debt ever could. Medical advances, better treatments, healthier lifestyles, all of this means that retiring at 65 and living to 95 is not some remote possibility anymore. It's increasingly common. That's 30 years your money needs to last. 3 full decades of expenses, healthcare costs that escalate as you age, inflation eating away at purchasing power year after year, unexpected emergencies that you can't even imagine right now. Imagine draining most of your liquid savings at 65 to achieve debt-free status because it felt right in that moment. You felt great about it for maybe 5 or 10 years. But now you're 78 or 82, and you're watching your remaining resources dwindle faster than you anticipated. The revelation hits you with devastating clarity. You optimized for short-term psychological satisfaction, for that feeling of accomplishment, but you left yourself vulnerable to the very real danger of outliving your money. The mindset shift that needs to happen is understanding that longevity risk, the risk of living too long with too little, is far more dangerous than the discomfort of maintaining a manageable mortgage. Dying with some debt isn't a catastrophe. Your estate handles it routinely as part of normal settlement. But running out of money at 85 while you're still alive, still need care, still have expenses, that's an actual catastrophe that destroys quality of life precisely when you're most vulnerable and least able to do anything about it. Write decades, not years, in the comments if you're starting to think about the long-term implications of decisions you might make today. The journey toward genuine peace of mind at 60 requires you to prioritize the right fears and ignore the wrong ones. Society has conditioned you to be terrified of dying with debt, as if that's some moral failing that reflects poorly on your entire life. But here's the hidden truth that should reshape your entire perspective. Your estate administrator handles remaining mortgage debt as a routine part of settlement. They sell assets, pay off obligations, distribute what remains to your heirs. It's paperwork, not tragedy. Your heirs aren't personally liable. They're not inheriting your debt. They're inheriting whatever's left after everything is properly settled according to law. But you know what actually is a tragedy? Running out of accessible money at 85, while you're still very much alive, still need care, still have daily expenses, still require medications and assistance. That's when quality of life collapses in ways that are genuinely heartbreaking. The transformation in thinking happens when you realize that the fear you've been carrying your entire life, the fear of dying with obligations, is actually far less dangerous than the fear you should have, which is outliving your resources while you're still here needing them. Now let's talk about why this stigma around retirement debt exists in the first place, because understanding the origin of this belief helps you recognize why it no longer serves you. Your parents and grandparents lived through an era when mortgage rates were 12, 15, even 18% during certain periods. In that environment, carrying debt was genuinely expensive and dangerous. Paying off a 15% loan early made brilliant mathematical sense. But here's the revelation that changes everything. We're not living in their world anymore. Today's environment of historically low interest rates has fundamentally changed the entire calculation. When you're carrying a mortgage at 3 or 4% in today's economy, you're playing a completely different game with completely different rules. Following advice that was designed for a 15% world when you're in a 3% world is financial malpractice against yourself. The impact of this shift is profound because it means debt can actually enhance your financial security rather than diminish it when you understand how to use it strategically within the context of current economic reality. Behind the scenes of financially successful retirements are people who recognized this shift and adapted their strategy accordingly. They're not blindly following what worked 40 years ago. They're evaluating decisions based on current conditions, current rates, current opportunities. The mindset required here is flexibility and willingness to challenge what you've always believed when the underlying circumstances have changed dramatically. But there's another dimension to this that becomes increasingly important as you age, and it's something most financial advice completely overlooks. As cognitive function naturally declines over time, which it does for everyone to varying degrees, the simplicity and accessibility of your financial structure matters more and more. Having liquid assets sitting in straightforward, accessible accounts that you can see clearly, understand easily, and draw from with a simple transaction becomes exponentially more valuable than having wealth locked up in complicated structures. The journey through your 70s and 80s requires financial management that doesn't demand peak mental acuity. You don't want to be 75 or 80 years old trying to figure out how to tap your home equity in an emergency, dealing with banks, filling out applications, waiting through underwriting, navigating processes that are confusing even when you're mentally sharp. The hidden truth about maintaining some debt while keeping your money liquid is that it's actually the simpler, less cognitively demanding approach that becomes easier to manage as you age. This is about designing your financial life for the person you're becoming, not the person you were at 50. The transformation in perspective involves recognizing that ease of management, immediate accessibility, simplicity in execution. These are features worth paying for, and the modest cost of maintaining low-interest debt is often a small price for the cognitive simplicity and immediate access it enables compared to the alternative. Put "simplicity wins" in the comments if you're recognizing that easy access to your own money might be more valuable than you previously thought. Context is everything in financial decision-making, yet most advice completely ignores it and just repeats the same tired principles regardless of circumstances. Your parents might have told you stories about racing to pay off their mortgage as fast as humanly possible, and in their world, that advice was absolutely correct. They were dealing with mortgage rates of 12, 15, sometimes 18% during the early 80s. When debt costs that much, paying it off aggressively is brilliant strategy. Every dollar you throw at a 15% loan saves you 15 cents per year, which compounds dramatically over time. But here's what shifts the entire conversation. We're not living in their economic reality anymore. The world they navigated, the rules that governed their decisions, the interest rate environment that shaped their strategy, all of that has fundamentally changed. When you're carrying a mortgage at 3 or 4% in today's environment, you're not playing the same game they played. Following their playbook in your situation is like wearing a heavy winter coat in the middle of summer because that's what worked last season. The transformation in understanding happens when you evaluate decisions based on current reality rather than inherited wisdom from decades ago. The journey toward actual financial security at 60 starts with one non-negotiable foundation that needs to be in place before you even think about debt payoff or any other financial goal. You need 2 to 3 years of living expenses sitting in easily accessible savings right now, not invested in stocks that could drop 30% next month, not locked in certificates of deposit with early withdrawal penalties, not tied up in home equity or retirement accounts with restrictions. I'm talking about liquid, accessible cash that you could touch tomorrow if you needed it. Money that's available for whatever life throws at you without having to ask permission from anyone or wait for anything. If you don't have that cash cushion built yet, then paying off debt shouldn't even be on your radar as a priority. Building that buffer comes first, always, without exception. The impact of having this foundation cannot be overstated because it's what protects you from every other financial threat you face. A substantial cash reserve shields you from forced asset sales when the market crashes and you need money for living expenses. It protects you from life's inevitable surprises, the medical emergencies, the home repairs, the family crises that appear without warning. It gives you breathing room to make rational decisions based on what's actually best for you, instead of desperate decisions based on immediate panic. Behind the scenes of every retirement financial disaster is someone who didn't have this buffer in place when they needed it. They had net worth on paper, they owned things, they had equity, but when crisis hit they had no accessible cash and everything collapsed. The hidden truth is that without adequate liquid reserves, you're always one emergency away from catastrophe, regardless of how much your house is worth or what your total assets add up to on a balance sheet that nobody can spend. The mindset shift required is understanding that this cash reserve isn't wasted money sitting idle. It's not being lazy or financially irresponsible by keeping money liquid instead of deployed aggressively. This reserve is actually your most important financial asset because it's what enables everything else to work. It's what lets you ride out market downturns without selling at the bottom. It's what lets you take advantage of opportunities when they appear. It's what lets you sleep at night, knowing that whatever happens tomorrow, you can handle it without destroying your long-term security. The revelation about building this foundation first is that it completely changes your priorities. Once you have this buffer in place, then you can start thinking about whether paying off debt makes sense. But until you have it, every dollar you're throwing at debt payoff is a dollar that should have gone into building the protection you desperately need. Comment foundation first if you're seeing why this cash buffer needs to be your absolute priority before anything else. Before you even consider writing a check to pay off your mortgage or eliminate other manageable debt, there's one simple question you need to sit with honestly, and your answer will tell you everything you need to know about what decision serves you best. Ask yourself this: if I pay off this debt right now using my accessible savings, will I regret not having this money available 5 years from now? Really sit with that question. Don't answer quickly. Imagine yourself at 65 or 70 or 75. Imagine medical expenses arising that insurance doesn't fully cover. Imagine wanting to help family members facing genuine crises. Imagine investment opportunities or life experiences you might want to pursue. Imagine the market crashing and needing liquidity to avoid selling at the bottom. If your honest answer is maybe, or probably, or even just I'm not sure, then don't pay off that debt. That uncertainty you're feeling, that's not weakness or confusion. That's your instinct telling you something critically important about your actual risk tolerance and your genuine need for flexibility. The transformation in decision-making happens when you trust that uncertainty instead of ignoring it in favor of following conventional wisdom that doesn't account for your real situation. What we're really talking about here is preserving optionality, which is one of the most valuable but least discussed concepts in retirement finance. After 60, having choices, maintaining options, keeping doors open, these things have value in themselves, even if you never exercise all those options. Being debt-free is one possible state among many possible states you could choose. And here's the revelation that should change how you think about this entirely. For people in today's low-interest rate environment who have adequate assets and reliable income streams, debt-free living is often not the best option available to them. It's just the option they've been told to pursue without anyone explaining what they're giving up to achieve it. The journey toward genuine financial security at this stage requires you to reject one-size-fits-all advice and instead build a retirement structure customized to your actual needs. That structure should maximize your security against real threats like healthcare costs and market volatility. It should maximize your flexibility to respond to opportunities and emergencies without panic. It should maximize your quality of life so you're actually living rather than just existing in fear. And it should maximize your ability to handle whatever the future brings without requiring you to predict exactly what that future looks like. For many people, maybe even most people who think carefully about their specific circumstances, that optimal structure includes maintaining strategic debt at low rates while preserving the liquid assets that provide real freedom. Behind the scenes of successful retirements are people who understand this and structure their finances accordingly, even though they might not advertise it because of lingering social stigma. But here's what matters most as we bring all of this together into something actionable you can use starting right now. If you're 60 and you're still broke or struggling financially, the worst thing you can possibly do is keep following generic advice designed for someone else's situation in someone else's economic era. The impact of continuing down that path is more years of unnecessary struggle based on rules that don't serve you, What you need to do instead is analyze your specific circumstances with brutal honesty. Look at your actual interest rates, your actual income sources, your actual liquidity needs, your actual health trajectory, your actual family situation. Challenge every piece of conventional wisdom you've been carrying. Ask whether it still applies given current economic reality and your personal context. Make decisions based on mathematical reality and strategic thinking, rather than outdated stigma and inherited fear. The mindset shift from following the herd to thinking independently about what actually serves your situation is perhaps the most important transformation you can make at this stage of life. Put taking control now in the comments if you're ready to stop following generic playbooks and start making decisions based on your actual circumstances. If you've made it this far, you're clearly someone who thinks deeply about these decisions rather than just accepting what everyone else is doing, and that matters more than you probably realize. The fact that you invested this time to genuinely understand a different perspective on managing money at 60 tells me you're approaching your financial future with the seriousness and thoughtfulness it deserves. Look, I create content like this because I believe people deserve to hear perspectives that challenge conventional wisdom, especially when that conventional wisdom was designed for an economic reality that no longer exists. If what we discussed today shifted your thinking even slightly, or gave you permission to question what you've been told, or helped you see your situation with fresh clarity, then subscribe to the channel. I dive deep into retirement strategies, financial decision-making, and the real-world implications of choices you're facing right now. This isn't surface-level content that repeats the same tired advice. This is the kind of conversation that gets into the nuance and complexity that actually matters when you're making decisions affecting the next 20 or 30 years of your life. And if you genuinely found value in this conversation, leave a comment saying this message was for me. So, I know this resonated with you and understand what topics matter most to the people watching. Plus, hitting that like button helps this content reach other people who need to hear a different perspective on retirement finances. People who are 60 and struggling and following advice that's making their situation worse instead of better. There's a video right here that takes this conversation even further, exploring specific strategies for building that cash buffer we talked about and maximizing your financial flexibility when resources are tight. Click and continue with me over there. I think you'll find it builds perfectly on everything we've covered today. Thanks for being here, for thinking critically, and for being willing to challenge the old playbook. I'll see you in the next one.